Most Australians have no idea they are legally allowed to pay zero tax on their super before they turn 60. Not reduce it, not minimize it. Zero. And the rules that make it possible have been sitting inside the super system this entire time, completely ignored by the people who need them most. Here is the truth. The super system in Australia is not designed equally. It rewards the people who understand how it actually works and quietly punishes everyone else with decades of unnecessary tax. The difference between someone who retires with $800,000 and someone who retires with $1.4 million is rarely income. It is almost always strategy. So today, I am breaking down exactly how to legally pay zero tax on your super before 60, using the rules that already exist inside the system right now, plus the changes landing on the 1st of July 2026 that make this more important than ever. Let us start with the foundation. Super in Australia is a tax-preferred environment. Money going in as concessional contributions is taxed at just 15%. Money growing inside your fund is taxed at 15% on earnings. But money coming out, under the right conditions, can be taxed at zero. That last part is where most Australians completely switch off. And that is exactly where the opportunity lives. The first strategy is the transition to retirement pension, or TTR. Here's how it works. Once you hit your preservation age, which is now 60 for anyone born after the 30th of June 1964, you can start drawing a TTR income stream from your super without fully retiring. You keep working, keep receiving your salary, and keep contributing into super. But simultaneously, you are drawing down a pension from your super fund. Here is the tax part that matters. If you are 60 or older, those TTR pension payments are completely tax-free. Every dollar. And because you are drawing an income from super, you can reduce your salary through salary sacrifice, meaning less of your income gets taxed at your marginal rate. You are legally shifting money from a high-tax environment into a zero-tax one. That single move, done correctly, can be worth tens of thousands of dollars in the years leading up to full retirement. The second strategy is the low-rate cap on taxable super components. Not all money inside your super is treated the same way when you withdraw it. There is a tax-free component, which includes personal after-tax contributions you have made over the years, and a taxable component, which covers employer contributions and salary sacrifice amounts. Between preservation age and age 60, withdrawals from the taxable component attract income tax. But here is the part almost nobody talks about. There is a lifetime low-rate cap. For the 2025 to 2026 financial year, that cap sits at $235,000. Any lump sum withdrawal from the taxable component up to that threshold is taxed at 0%. Above it, the rate jumps to 15%. If you are planning to access super between 60 and 65, this cap can allow you to pull out a significant lump sum completely tax-free if you time it correctly. Get the timing wrong, and you hand money to the tax office that you never had to. The third strategy is maximizing your non-concessional contributions before retirement. Non-concessional contributions are after-tax dollars you put into super yourself. They go in with no additional tax because you have already paid income tax on them. They grow at 15% inside the fund, and when you eventually pull them out, the tax-free component means that portion of your withdrawal is completely tax-free. By deliberately building up your tax-free component before retirement, you are essentially creating a tax-free income stream for your future self. The Bring Forward rule lets you contribute up to 3 years of the non-concessional cap in a single year, which from the 1st of July 2026 means up to $330,000 in one hit if your total balance allows it. That is a powerful lever for anyone with a windfall, a property sale, or an inheritance. Now, here is where the 2026 changes add a layer of urgency. The Division 296 tax, which kicks in on the 1st of July 2026, applies an extra 15% tax on earnings inside super for balances above $3 million. The effective rate on those earnings hits 30%. And critically, that $3 million threshold is not indexed to inflation. It doesn't move. A 35-year-old contributing consistently today could easily cross that line by retirement, which means the strategies that protect you from unnecessary tax are not just for the wealthy. They are for anyone who plans to stay in the workforce for the next 2 or 3 decades. So what do you actually do with this? First, check your super balance today on MyGov and identify your tax-free versus taxable components. That split will tell you exactly where your tax exposure sits. Second, if you are within 5 years of 60, talk to a licensed financial advisor specifically about a transition to retirement strategy. The numbers are almost always compelling. Third, if you have received a windfall, a bonus, or you are sitting on cash, look at your non-concessional cap and bring forward rules before the 30th of June. The window closes and reopens every financial year. Fourth, if your balance is tracking toward $3 million over a 20 to 30-year horizon, start planning now. The tax you avoid early is the compounding you keep forever. The Australians who retire with the most are not the ones who earned the most. They are the ones who understood that super is not just a savings account. It is a tax structure. And every year you treat it like background noise is a year you are leaving money on the table that belongs to you. If this video changed how you think about your super, hit the like button and subscribe to the channel. Turn on notifications so you do not miss the next one. I will see you there.